Price doesn't move randomly. It gets pulled towards liquidity. And once I understood where that liquidity is, I became a lot more profitable. But most traders struggle with liquidity because the way it is taught is just way too complicated. So today I am breaking down the only liquidity trading strategy worth learning. 3 simple steps. And we'll go through live trade examples to show you exactly how this plays out on the charts. Let's dive in. Step 1. Identifying liquidity before we can identify liquidity. We have to know where it actually sits in the markets. And the truth is, liquidity sits in very obvious places, because liquidity is simply where traders put their stop losses. So where do traders put their stop losses? In this example, we have a very obvious level of support, and all the stop losses are going to be below this level. Traders see this level being respected multiple times and expect it to be respected again. So they set up their buy trade and then boom, they get knocked out before the trade inevitably goes in their direction. This obvious liquidity sweep knocked them out of the trade. And the same thing goes for sells. There is an obvious level of resistance. Traders put their stops above this level, set up their short positions, get ready for a big win, and then boom, the liquidity sweep knocks them out for a loss again, before the trade went perfectly in their direction. So by knowing where liquidity is, I avoid stupid losses and get high probability trades. And this happens every day in the markets. We get an obvious level. Liquidity is below that level. It gets swept out of the markets. Then price reverses all the way up, hopefully to take profit. Let me show you some examples. Obvious level, liquidity sweep, price reversal. Obvious level, liquidity sweep, price reversal. Obvious level, liquidity sweep, price reversal. You see the pattern. Why this works? I call this the institutional trade ladder. Retail traders like you and I don't have large enough trades to move the market. But institutions do. Let's say an institution wants to get into a buy order right here. There simply won't be enough liquidity to fill all their orders at this price. So they have to buy here, and here, and here because they're pushing price up with their big orders. They're getting a worse price. But they don't want a worse price. They want all their orders at the original price they actually wanted. So instead, we have our obvious level of support here, and you have all the retail stop losses down here. The institutions will push price into those stop losses, absorb all of those sell transactions, and then they can actually build a large position at the original price they wanted. And that is where the real move begins. Step 2. Sweep or run once liquidity is taken. You'll either get a liquidity sweep or a liquidity run. For this strategy, we want to focus on the sweep. We've got the support level, we get the sweep, we get the reversal. That is what we want. We want to avoid the run. In this example, we have an obvious level of resistance. Looks like we're getting a sweep here, but instead we get continuation in the form of a run. I find the sweep gives way more consistent trading results, which is why I focus on that in my liquidity trading strategy. So how do you avoid a run? If a run is going to happen, it is because of an impulsive break. So we're always waiting for the candle closure. Don't have the short position ready right here, because if the candle breaks out impulsively and closes, it is very likely we're going to see a run. To avoid the run, just make sure there is no impulsive break. We just want to see a candle come down and wick. Just a wick, then we're reversing up. Step 3. Execution. Now let's get into an actual trade. For this part of the strategy, I am on the hourly time frame. That is where I am looking for the liquidity sweep. Once I get the sweep, I am looking for the reversal. So I am only looking for buy trades. Then I come down to the 5-minute time frame. We just had the sweep occur. So again, I am looking to place buy trades right now. I am an orb trader. So I am looking at the first 15 minutes from 9:30 to 9:45, and I am marking out the candle high and the candle low. This creates my trading range for the session. And all I want to see next is a candle break and close outside of the range with displacement, which is exactly what I get. This is another indication that I am looking for buys and that I have positive momentum. After that, I am looking for my point of interest. And the candle printed a level of demand right here. This is the red candle before the big push up with big green candles giving us displacement. A price push this aggressive tells me that smart money is likely resting at this demand level, looking to get in on buy positions. So now I am simply waiting for price to come back to that level of demand, test that level, and give me some sort of indication that I can get into a trade. Which it just did. It gave me a bullish engulfing pattern. The red candle is engulfed completely by the green candle. That is the next step of momentum telling me I want to place a buy position. So on that candle closure, I am getting into the trade. Stop loss below this recent level. Take profit all the way up here because we have a strong level of supply. This trade is ready to go. Liquidity was swept. We had the displacement push and candle closure outside of the orb. We respected the level of demand and got our bullish engulfing pattern. The only thing left to do is play the position out, and you can see it started to go in my direction with some big candles. There clearly were buyers at that level of demand, and then I smashed the take profit perfectly. Now obviously after a liquidity sweep, you can enter a trade on support and resistance, supply and demand. It doesn't always have to be an open range breakout, but this strategy works and it works consistently. That is liquidity trading. 3 steps, high probability, low stress, trade smart, and I'll see you in the next one.